Look at this chart. The market has been trending downward, and right at the absolute bottom, a perfect bullish engulfing pattern forms. Most retail traders see this textbook shape, immediately execute a buy order, and place a tight stop loss beneath the lowest wick of that candle to protect their capital. But here is what actually happens. The next bar punches down just far enough to trigger that stop loss, kicking the trader out before rocketing upward. Why does this failure occur? We must look below that line. That area is packed with accumulated market orders. While a retail trader is staring at a 2-bar geometric shape, institutional algorithms are looking at those predictable stop-loss placements as liquidity traps waiting to be swept. To stop acting as institutional liquidity, we have to redefine market conviction. A simple 2-bar shape is not enough. This comparison shows the difference in actual momentum. On the left, the green body covers the previous red body, but leaves the wicks exposed. On the right, a true institutional engulfing candle completely eclipses the entire range, both the body and the wicks, of the previous session. When you see a candle close with virtually no wicks at all, a style known as a Marubozu, you are looking at the gold standard of conviction. The smart money held their positions straight into the close, without allowing a single retracement. Even a perfect Marubozu candle is highly prone to failure if it prints in the middle of a sideways trend. In the middle of nowhere, high momentum is just noise. This chart maps the institutional requirement for confluence. High momentum signals need to originate precisely where major structure exists, like when the price strikes a historical support band, intersecting perfectly with a 61.8% Fibonacci retracement level. An engulfing pattern gains its predictive power only when it acts as an active, violent rejection of a deeply discounted price by major financial players. Once you have the right pattern and location, you still have to verify exactly who is responsible for moving the price. The CME Group's official documentation outlines a core principle: volume must validate price. Because Forex is decentralized, tick volume is the most reliable proxy we have for spotting heavy institutional participation. This chart pairs price action with a volume histogram. A true institutional signal separates itself from low retail volume by printing a massive breakout volume spike, towering over the preceding 5 to 10 bars. The habit of hitting the buy button the precise second a large candle closes exposes traders to unnecessary drawdowns and poor entry pricing. A conservative entry model waits for the pullback. By placing a limit order exactly at the 50% retracement line of the engulfing handle's body, you catch the inevitable moment when institutions retest that midpoint to fill their remaining orders. From that entry, we need a final layer of mathematical protection. Stop guessing where to place your stop loss and use the average true range, or ATR, indicator to measure the market's current volatility. By calculating the ATR, you can drop your stop loss exactly 5 to 10 pips strictly below the pattern's lowest wick. This creates a buffer zone that keeps you perfectly safe from the institutional stop hunt we saw earlier. Combining a midpoint entry with an ATR buffered stop shifts your risk-to-reward ratio, turning a vulnerable gamble into a mathematically protected institutional play. What is the protocol when an engulfing setup meets every single institutional criteria we just covered and still fails? This chart illustrates the failed engulfing trap. After a perfectly validated bullish signal, the following candle aggressively wipes out the entire range. Institutions engineer this fake-out to induce retail buying. The forced liquidations of trapped buyers act as fuel, accelerating the downward institutional short. Professional traders recognize this trap instantly. Instead of closing their platforms in frustration, they flip their bias and immediately trade the resulting trend continuation signal. Elite trading relies on understanding market mechanics and tracking the flow of liquidity. It is a discipline of observation, not memorizing geometric shapes from beginner textbooks. To apply this logic to your own charts and filter out market noise, download the institutional price action checklist below. You can immediately test this new framework by opening a demo account on the FXNX platform, which features ultra-fast execution and 0.0 pip spreads. Transitioning from pattern matching to liquidity analysis allows you to stop reacting to simple shapes and start executing on the same side as the algorithms moving the market.